In some ways, it feels like 2016 again.
Yeah, exactly. Certainly, former President Trump wants it to be 2016 again. Whether it is or not is a different question, which we're going to ask Eswar now. Eswar, thanks so much for joining us. First of all, give us a sense of what happened in the wake of Donald Trump and then Joe Biden really continuing all those tariffs. Where are we with the balance of trade between the United States and China right now?
Things have certainly shifted, David. What happened, of course, is that you had the Trump tariffs being continued by Biden because none of the tariffs came down. And in addition, there have been a variety of other restrictions on technology exports to China and other types of trade and economic restrictions. All of this has certainly had an effect on trade between the two countries. In early 2016, China accounted for about 22% of U.S. imports. That number is down to about 14%. Later this week, we'll have the full year trade data for 2023, and it's likely to show the smallest goods trade deficit relative to China as a percent of U.S. GDP at around 1% of U.S. GDP over the last 20 years. So certainly there's been a big effect of what Trump has done and what Biden has done. And certainly, given where the political climate is in Washington right now, there isn't much prospect for an improvement of trade relationships between the two countries.
And it's interesting. I mean, you make the point that, of course, these tariffs that Trump put in place, they didn't come down under President Biden. And with that in mind, as we head to the 2024 election, you have Trump obviously campaigning on being tough on China. But how different are these two candidates truly when it comes to trade policy?
It's certainly going to count as a political win for Biden in the lead up to the elections that the trade deficit with China has come down so much because much of this reduction actually happened in the last 3 to 4 years, and imports from China have declined. Now, all of this has happened at a time, of course, when the U.S. economy is very strong. U.S. imports overall have done well. So there is something structural going on here. But one interesting question, Katie, that's not quite clear yet is whether actually imports from China have fallen or if these are simply being diverted through countries with which the U.S. still has friendly trade relationships, such as Mexico and Vietnam. But there is certainly something fundamental changing, and it's going to be much harder for Trump to make the argument that the Biden administration has not been tough on China, because if you look at the numbers, certainly it looks like Biden has delivered.
Eswar, I wonder if you directly address what we heard from the former president on Sunday, which is he's really contemplating 60%, he even said, or even more, tariffs on China. We talked to Paul Krugman last week, who said, look, if you get to that level, that's not regulating trade, that's just cutting it off. What would be the effects of a 60% tariff on goods from China?
That's right. A 10 to 20% tariff, acts like a fence, David. But if it's 60%, it's an impenetrable barrier because that sort of margin, no Chinese exporter or U.S. importer can really deal with. Because if it's 10 to 20%, you can think about trimming costs here and there. Currency depreciation of the Chinese renminbi helps a little bit. But when it's 60%, that's a signal that the administration here is very eager to basically cut off trade with China, which is what the effect will be. And it will have an effect on trade flows and investment flows. Again, the interesting question is whether this will simply lead to a diversion of trade. But once you get to talking about 60% tariffs, that's going to be effectively blocking trade between the two countries.
Well, when it comes to the diversion of trade, something that I've been wondering is, does anyone win in this context? I mean, you think about India, for example, if trade relations between the U.S. and China really deteriorate further from here, who stands to benefit?
Now, that's an interesting question, Katie, because it turns out that it's not just trade flows, but also flows of foreign direct investment and other types of capital that are beginning to fall more closely along geopolitical lines. And this certainly could create some winners, not in the very short term, because, realistically, again, unless you have 60% tariffs or actions of that sort, it's going to be difficult to substitute at scale a manufacturing base such as China. But at the margin, we're already beginning to see U.S. manufacturers beginning to shift to other friendlier countries, such as India, Vietnam, Mexico, and so on. So countries with which the U.S. has a more open trade relationship are certainly going to benefit in terms of trade flows as well as investment flows, and we are beginning to see that in the data already.
Eswar, there's one thing of what the level of tariffs are, what the trade policy is. There's another about just not knowing what they are, the uncertainty that's injected, particularly with respect to investment. As you know, foreign direct investment in China has really dropped off. What is the friction cost, as it were, of just uncertainty about where we're headed with our trade policy?
For investors, there is a huge amount of uncertainty right now. If you think about investing in China, either as an equity investor or as a company trying to put in place foreign direct investment, there is the macroeconomic risk in China because the economy is not doing too well. The stock markets have been cratering recently and deflationary risks abound. Then there are the policy risks, what the Chinese government is going to do to private enterprise in the future. And if the renminbi continues to depreciate, will they put in place capital controls? Now, rolled on top of all of that is the geopolitical risk. The US-China trade hostilities are one part of that, but there is this broader reshaping of the alliance between the two countries and with different countries jockeying for places these two superpowers go at it. So the amount of uncertainty that is created for investors around the world is enormous. This is not to say there aren't opportunities to be had because China is now, a $19 trillion economy. Even if it grows at 4 to 5%, that's still a lot of domestic demand growth. The stock market may have bottomed out if the Chinese government is willing to put in place policies to restore confidence. So for anybody, any investor with a very strong stomach, there could be opportunities, but the landscape more broadly is one of uncertainty in every dimension.
Well, to that point, you take a look at Chinese-focused ETF inflows, and they're seeing huge demand, investors trying to time that bottom. But you talk about the uncertainty among investors, among businesses, and typically we talk about investment into China. But what's striking to me is that Goldman Sachs had a survey out of its onshore clients in China, and you take a look and a potential win by former U.S. President Donald Trump in the November election. That was a big concern. And also, you take a look at sentiment around China's economic prospects for this year. Was very negative. So that uncertainty, it's not just shared by foreign investors, but it's also investors within China who are not feeling too great right now.
That's definitely true. There is uncertainty about the macro and policy environments, like I said. But in addition, given that the political environment is shifting, becoming much more hostile towards private enterprise, towards people who are not seen as closely allied with Xi Jinping, that is leading to capital leaving the country. So right now, China and Chinese financial markets are under a significant amount of pressure because foreign investors are not coming in and domestic investors are looking for safer places to put their money. So this is a pretty fraught time for China in a variety of dimensions. And the key issue is whether we're going to see policies from the Chinese government that not only restore confidence in the short run, but really restore confidence in the long-term direction of the economy. And so far, we haven't seen that.